Hey, welcome back to the channel. Jeff Smith, Fairways in Finance. And today I want to take you through an example of a client pre-qual consultation. And so what is a pre-qual consultation? Well, I think it's the most important client interaction that I have. And so my process, to give you just a quick summary, I have an initial call with the client. That's a needs analysis call, 15, 20 minutes worth of information gathering to find out what their goals are, what their needs are. Then I have them submit an application online, submit their income and asset paperwork. When that comes in, I review all of that paperwork, run their credit, put together the numbers, and if I have them pre-qualified, I issue their pre-qualification letter. From there, there's a link in the email template that I use for my buyers to schedule a consultation on my calendar for the pre-qual consultation. That is a video meeting where we will spend 30 to 45 minutes going through all the details of their mortgage pre-approval. The numbers look like, we'll review what I call the most important two numbers in the transaction, which is cash to close and total monthly payment. I'll give them an overview of the Arizona purchase contract, and then I've got a document that I like to review with 7 tips for not getting yourself in trouble after being pre-approved for a mortgage. So, that mortgage pre-approval is based on someone's finances as they stand at the time they submit the application. But there's several things that could trip them up down the road, like getting a new car loan or taking out additional debt. And so 7 key points I like to go through for folks to make sure that their finances stay in a position to qualify for a mortgage. So during that pre-qual consultation, I like to do it over video. It allows me to see my clients, interact with them face to face. But because it's virtual, it's also much more convenient for my clients, and they don't need to drive across town to meet with me at my office and get their kids out of school, all that stuff. So video is preferred. If they can't do video, we'll do a phone call. And I just think it's absolutely crucial that you do a professional loan presentation, giving the client all the information they need. This is where you can really build that rapport and trust and educate your client. This is where you make sure that there's no surprises when they go through the approval process for the mortgage. And this is where you can make sure that they're set up for success when they go out with their realtor to start shopping homes. I did this call today. I recorded a live call that I had with Paige Morlino at Limitless Real Estate. She wanted to see what that consultation looked like in person, so she joined me and somewhat pretended to be the client. So it's just crucial to have a system and a process in place. One more thing before we go into this recording. This is the same process that I use every time in a pre-qual consultation, and I've refined this presentation over the years to answer every client question that could come up. I've added things, I've subtracted things, but the outline that you're going to see here moving forward is one that I've been using for several years now. And after I go through all that information, it's rare that I really get any questions from clients, because I've tailored the information to answer every question that is going to come up for most people. So hope you enjoy it and let me know what you think. Okay. So I would start any pre-qual consultation just with, some small chat for a minute or two to break the ice, and then, open it up with, do they have any questions about the process? At this point, a client, I've already reviewed all of their paperwork. They've submitted their application. I've run their credit, and I've issued a pre-qual letter. So when your clients are going through this meeting with me, you will have already received the signed pre-qual letter from me. And now they're scheduling this appointment to go, through what all the numbers would look like. So then the first thing that I'll do is take the client through a couple financing options that I put together for them. So I'll share my screen, and we'll go through 2 options that I put together for a client about a week ago. Now, this client, their credit scores, are pretty good, but they're not like in the top tier. So the rates are higher than it would be, if they had top tier credit. And so for these particular clients, they had submitted an offer on a property, and we had a lender credit. So I'm going to explain how we were utilizing that. So this was very, specific to what they're looking for. So I've put together two options. So we're going to go through a lower interest rate option at 8.125, and then we're going to go through a higher interest rate option at 8.5. And we'll explain the differences there. So purchase price or property value, $395,000 in this case. And this is a purchase, 30-year fixed rate mortgage, $100,000 down, which is what we had discussed at the application stage. So that's a financed amount of $295,000. Primary residence is the occupancy. Interest rate on this first option is 8.5. And then the APR is over here. It's 8.668. So the difference between APR and interest rate is the APR takes the closing costs, converts those to a percentage, and then adds it to the rate to give you an idea of what the overall cost is of the loan. But what you're actually paying to borrow the money is the 8.5%, the interest rate. So then we're going to go through all these closing costs. First, I'm going to skip down here to the payment, and we'll talk about the payment in this box. So payments down here in the lower right, $2,499 a month, and that's comprised of four different components. So the first is the payment for the mortgage itself. We call this principal and interest, $2,268.29. So this is an exact payment for all 30 years on a 30-year fixed rate mortgage. That will never change. Next item is homeowners insurance or hazard insurance. That's an insurance policy that a client would take out through whatever insurance company they prefer to use, Geico, State Farm, whoever. That protects the property from major hazards like fire or water damage. And so especially when someone's buying a home for the first time, it's important to think about homeowners insurance as like catastrophic coverage. It's not a policy that you want to use very often, where, like with car insurance, like if you got into a fender bender, you would use your car insurance. With homeowners insurance, you only want to use it if it's some sort of expense that you cannot pay for out of pocket, because what the home insurance companies do is they track your claims, even if you move to another company. They know if you've had claims, and that goes against your record and makes your premiums a lot more expensive. And so the other thing that you can do is, depending on what your cash savings position is, you can select different levels of deductibles to go with the policy. So like for me personally, I always select the highest deductible I can, because I know that I'm only going to use my homeowners insurance if it's a big ticket repair item. You know, if it's a couple $1,000s, I'm going to pay for that out of pocket. So I've got our insurance deductible at $10,000, which is pretty high. And that might not, that might be too high for some people, but a lot of times the insurance company will put you in with like the lowest deductible, which if it is $1,000 or $500, you don't want to use your homeowner's insurance for $1,000. You want to use it for a $10,000 claim, or more. So that could help to save money on the monthly premium when you have a higher deductible. Then I put these worksheets together based on a specific property. So the taxes for this particular property are $95.73 a month. If we didn't have a property identified, then I would just have that estimated percentage. And then the HOA dues for this particular home are $53 a month. So all of that totals up to $2,499. Now the HOA will be a separate bill. So the $2,500 encompasses all of those items, but the HOA will be paid directly to the homeowners association, either quarterly or monthly or however they bill it. Next, we're going to go through the closing costs. So this top section is lender fees or origination charges. So on this interest rate, when I ran pricing on this day, the 8.5% interest rate had discount points of $687. So on this particular day, we could have gone to 8.625 and eliminated any discount points. So then there would be zero lender fees. But I thought this made sense to select this option, because when I put this worksheet together, we're working with some credit from the seller that we were anticipating. So we're utilizing that. You'll also notice that I have no flat lender fees that I charge. So most mortgage companies in this section, you'd see like an underwriting fee between $1,000 to $1,500. I don't have any flat fees like that. Next section here is services borrower cannot shop for. So this is third-party charges. So we've got the appraisal fee, which I'm estimating at $600. I'd expect it to come in between $500 to $650, depending on the property. Credit report, I estimate 100 up front. The actual cost of a credit report is $72.50. Sometimes we have to get some additional supplements to go along with that could push the cost to 100. Flood certification, $25. We work with a third-party processing company to do all the verifications of employment, fraud checks, tax return transcripts, all of that stuff. So they charge $9.95. And then if we had to pay to get a verification of employment through your employer, this is an estimate of what that would cost. If we can get a verification of employment with no charge, like through your manager or HR, then this gets deleted. So that's third-party charges. This next section, services borrower can shop for. This is an estimate of what a title company is going to charge in the transaction. So my computer system just estimates this based on a percentage. And the title company, they do a few things in the transaction. One, they provide a title report, and the title report tells us who's had ownership interest in the property over its history, and whether or not there's any liens against the property. And that's a really important part, like tax liens or judgments. Title company provides 2 title insurance policies, a lender's title insurance and owner's title insurance. The title insurance guarantees that title is free and clear at the time that you close. So if a lien holder were to come after you for payment on some lien that had been put against that property previously, and it didn't come up on the title report, that in effect could be something that you owed. But if you have title insurance, the title insurance would pay off any liens that did not come up on the title report at closing. So it guarantees that you have a free and clear title at the time that you close. So there's an owner's title insurance, which is paid for by the seller, that protects you for your ownership interest in the property. Then there's a lender's title insurance, which protects the lender for their amount of the mortgage. And that's paid for by you as the buyer. And then the last thing that the title company does is they handle the signing of all of your closing paper. So at the end of the transaction, you're going to pay your down payment money plus closing costs to the title company with like a wire transfer or a cashier's check. And they will do the signing of all of your closing paperwork with you, and then they'll distribute all of the money at the end of the transaction. So my system always estimates these title fees a little high, but I like to have things a little higher up front. Numbers go down. Everybody's happy when the numbers go down. Nobody's happy when the numbers go up. So definitely don't expect them to be any higher than that. The county will charge about $60 for recording the deed of trust in your name at closing. These 2 boxes here, prepaids and initial escrow payment at closing. So a few things we got going in here. One, the first year of your homeowner's insurance right here is going to be paid at closing. So this is 12 months of hazard insurance. So let's say your insurance provider is Geico. This $987 will cover your homeowner's insurance policy for the first year that you're in the home. Then as you're making your monthly payments throughout that first year, you're going to put 12 additional months of homeowner's insurance into your escrow account to cover that Geico policy when it comes due again the next year. So it's paid once a year in advance. So this is the upfront amount that gets paid. And then the lender's also going to collect 2 months of reserves right down here to go into the escrow account in case that policy cost increases over time. That way there's enough in there to cover it. And then same thing with taxes. They're paid every 6 months in October and April. And the lender's going to put 2 months of reserves into your escrow account at closing, so there's enough money in there at the time that we close, so that there's enough money in there when that next installment payment is due. You'll also get a credit from the seller for the amount of taxes that they owe up through the date of closing. And then the last line item is called prepaid interest. That's right here. And so I've got this set at 15 days. This covers the interest for the remaining days in the month that you close. So say, for example, you close on a home on November 15th. First new mortgage payment would be due January 1st. That January 1st payment covers the interest from the month of December and only December. But if you close on November 15th, you'd have the mortgage for 16 days from the 15th of November through the 1st of December. So the lender will collect those days of interest at closing. That's called prepaid interest. That's just a one-time thing that happens on closing, and it depends on what day of the month that you close. So I've got this set at 15 days to give you a middle figure there. And then, so with this offer that they were submitting, They were asking for $11,400 in concession from the seller as to go toward closing costs. So one of the things we added in there was a 2-1 temporary buy down. So the cost of the 2-1 temporary buy down in this scenario was $7,209.75. So the 2-1 temporary buy down, the way that works is they'll be making a payment equal to a rate of 6.5% in the first year, so 2% lower, and then 7.5% in the second year, 1% lower, and then 8.5% from year 3 through 30. So this payment down here is the 8.5% interest rate payment. And then that year 1 payment was going to be about $400 less, so $2,100. And then that year 2 payment was going to be $200 a month less. And then it would go to that full payment amount in year 3. So this temporary buy down money, the thing that's great with the 2-1 temporary buy down is the 7,209 goes into the escrow account at closing. So it's not like a fee, it's the interest that's been prepaid up front over those first 2 years. So if this buyer refinances their mortgage within the first 2 years that they have the home, whatever is unused out of this 7,209 gets refunded back to them as a principal payment against the loan. So like in year 1, each month that they're making the payment, it's $400 a month less than what this stated payment is down here. So $400 a month is coming out of the escrow account out of this 7,209. So that's how that temporary buy down works. And it's got to be paid for fully by the seller, because if the buyer were to pay this, they're not actually saving themselves any money. They're just repaying the interest up front. It's not costing them more money, but it's not saving them money. So the lenders want the seller to pay for that. So down here, we've got their total estimated cash to close at $104,000 basically. And that is the down payment of $100,000, plus all the closing costs we went through, plus that temporary buy down, and then minus the $11,400 credit from the seller. So, with all of these charges here, including that temporary buy down, they're basically paying $4,000 of it, and the remainder is all paid for by the seller. So that's option 1. Okay. And then option number 2 is basically the same thing with a couple changes. So the interest rate here is lower. So we're at 8.125. Discount points are higher, 3,950. And then that makes this, payment a little bit lower. So 2,421 versus 2,499. So that is $2,499 minus $2,421. That's $78 a month less in interest because of the rate, but they're paying more in cost up front. So $3,950 versus so they're paying $3,263 additional with this option right here to save $78 a month. So if I take the $3,263 divided by the $78 a month savings, it is 42 months to break even on that money. Meaning it's going to take 42 months to save the additional $3,300 that they're paying up front. So unless they're keeping that home or unless they're keeping that mortgage for 42 payments, which is 3.5 years, they're going to be better off taking the higher rate with less points. And I especially would recommend that in this environment, because I think the chance of them refinancing to a lower rate the next 3.5 years is pretty high. So we don't want to invest a bunch of money in points when rates are up. When rates are down, it makes more sense to invest in points, but not in this environment. But so we'll go through that and then answer any questions they have. Cash to close here is a little higher because the closing costs are higher. We've added the discount points. So that's all taken through the worksheets, and we've had a discussion up front. So even if they don't have a property picked out, I know like what their goals are in terms of total cash to close, monthly payment, all that. So I'll dial these numbers in so that it's fitting exactly where they want to be. And then this is a good time for us to figure out, okay, so this is what you told me your goals were. How do these numbers match with your goals? And then sometimes it's like, well, that payment is too high, or well, we'd really like a higher purchase price. What is that going to cost us? So then we'll kind of iron that out. Next thing we'll talk about is just some do's and don'ts moving forward in the process. So, now that we have the buyer pre-approved, it's all based upon their finances as they stand today. So we don't want to have any major changes to the buyer's finances between this point and closing on a home, because it could impact what they're qualified for. So these are some things that I've come across over the years that have tripped buyers up on their pre-approval. So we don't want any financed purchases, major purchases like furniture, appliances, jewelry, that kind of thing, cars. Not to say they can't do it, but if they're going to do that, I recommend that they contact me first so I can review that on their application, let them know if it'll impact them. We don't want buyers to change or quit their job. Now, the one that catches people by surprise is sometimes people will get a promotion or they'll take a new job at a higher rate of pay, and they don't bring it up because they're thinking, oh, well, I'm making more money and it's a good thing. And that generally is, but if their structure of pay changes, like they go from salary to then like a salary plus a commission type of position, unless they have a history of that commission, then we can't use it. So even though their overall income may be going up significantly, what we can use as qualifying income may be a lot lower because part of it's variable. So that's always important. If someone's going to change their job, I want to know so I can tell them if it'll impact them. We don't want people to move large sums of money. Not that it causes an issue for getting approved, but it just creates a situation where we have to get more paperwork documenting the money going out of one account and into the next. Wire transfer policy with your bank. So this can come up with out-of-state buyers. Some small banks require an in-person signature to initiate a wire. And years ago, I had a buyer who had to fly back to Minnesota just to sign one document to get a wire transfer out of her checking. And so it was a bad situation. And so this I always like to bring up for people, especially if they're out of state. If they've got one of the big banks that are nationwide, it's not anything to worry about. But that's why I have that on there. Also, anybody receiving money from someone to go forward cash to close in the transaction, as long as it's from a family member, it's an acceptable source, and we call that a gift, and we can document it appropriately. But buyers could not get money from a non-family member to go toward down payment and closing costs. We don't want an increase in debt because that could impact their debt to income ratio. That could also impact their credit score. And then we want to make sure all bills are paid on time. So especially for someone who has had some credit history challenges, one 30-day late payment can torpedo a pre-approval. So we just want to make sure people are really careful with paying their bills. So I'll send this document to clients right after the meeting in DocuSign, and then I just get their initials on it in the middle here, just so we're all on the same page.
That's great.
Yeah, just so they know too, like this is important, and this can really trip you up. So that's that. And then the last thing that I'll take them through is just some high points of the Arizona purchase contract, just so they're hearing it again and starting to get a better idea of how that whole process works. So, now you're pre-approved, you're going to go out, you're going to shop for homes. Once you find a home that you like, Paige is going to write up an offer and submit that to the seller and their agent with your terms for the offer. So you may negotiate back and forth until you've agreed on terms. And then once you've agreed to terms, you're what we call under contract. So the first thing that happens when you go under contract is you need to write a check to the title company for the earnest money deposit. The earnest money is typically 1% of the purchase price. And that is a non-refundable deposit that the title company holds during the approval process of the transaction. It's refundable in some cases, and we'll go over that. So the first 10 days of the contract is called your inspection period. So Paige is going to set you up with a home inspector to go out and do an inspection of the property. So they're going to do a thorough review of the physical condition of the home, and then they'll give you an inspection report with what they came up with in terms of the condition of the property. So, especially for somebody buying a home the first time, I always like to warn people, there's going to be 30 items on this inspection report. And that doesn't mean that the house is falling apart. Every home, even a brand new home, is going to have items that come up on an inspection report. But the home inspector and Paige will guide you through, like, here's items that's normal deferred maintenance you'd see on any home, and here's items that we should be concerned about. So the cost of the home inspection, it depends on the size of the home, but anywhere from $400 to $700 I would plan on for a home inspection. And you're going to pay that inspection fee directly to the home inspector. They'll take like a credit or debit card from you. So that's like the one fee that I don't have accounted for on my worksheets. During that 10-day inspection period, your earnest money is refundable, and you can cancel the contract for any reason. So that's like your due diligence period over those first 10 days. So that's your time to research the neighborhood, get homeowners insurance, do the inspection, all of that. During that process, we'll start the approval process for the mortgage. So once you have an accepted contract, that's the point at which we could lock your rate. So these rates we reviewed today are today's rates. Whenever you go under contract on a home, we're going to reprice the rates based on what rates are on that day. But then once you're under contract, we have the option to lock the rate, which would set it at where it's at. We'll have disclosures for you to sign with an electronic signature. You're going to hear from my processor, Erica Dobrinsky, and she's going to be a point of contact for you, helping to put together the paperwork we need to approve your loan. And then we'll go through 2 rounds of underwriting. So first time we go through, the lender will say, okay, loan is approved, pending some additional items, and Erica and I will let you know what those are. Once the home inspection is done, if that all looks good, then we'll order the appraisal. So once we order the appraisal, you're going to get an email with a link to charge your credit card for the appraisal fee, and that's a non-refundable fee once we collect it. So we like to wait until after the appraisal's done to make sure there's no deal breaker, or wait until after the inspection's done to make sure there's no deal breakers on the inspection. And then once the appraisal's done, we'll take that along with any additional paperwork we collected from you, submit that back to underwriting for a second and final review. And then once we have final approval on the loan, the title company is going to schedule you to sign closing paperwork. And at that point, then we'll have an exact number for your cash to close. So up until then, we're going to have a projected number, which is going to be reasonably close, but not exact. And at the very end, we'll have the exact number. So typically you'll sign couple of days prior to closing, and then the title company will help you set up that wire transfer or have you bring in a cashier's check, sign closing paperwork, and then on the day of closing, that's when the transaction funds and closes. So the lender wires the money for your loan to the title company, and once the title company records the deed of trust in your name with the county, that's the point at which the property is officially yours. And so we like for clients to plan on that happening by the end of the day, because there are several steps that take place during that time. And sometimes there can be delays with wire transfers going through banks. So typically Paige is going to be giving you those keys late in the afternoon on the day of closing.